Wealthy people use their assets as collateral in order to get extremely low interest rate loans. And the thing is, a lot of everyday people could implement a similar strategy to get similar low interest rate loans, sometimes 2% or below. Hi, my name is Pascal Manigat and you're watching the Financial Ownership Podcast. Let's say, for example, you have $100,000 and say this $100,000 is invested in an index fund in, say, either Fidelity or Charles Schwab. The thing is, a lot of these financial companies, they'll allow you to take loans against these assets. So if you have an index fund, they'll allow you to borrow a certain amount. The good thing about that is you never actually have to liquidate your asset. So what does that mean? That means you keep the earning power of it. So you could potentially borrow at a cheaper rate and earn at a higher rate. So you make a spread every time you use your money by taking loans against your assets rather than liquidating it. Let's say, for example, you get 10% on a said index fund. If you borrow at a rate of 2%, now you're basically making an 8% spread every time you use your money. Versus if you just use your money directly, you wouldn't make any money at all. And the thing is, a lot of these financial companies will allow you to borrow 50 to 60% of your stock market asset, considering what type of stock market fund it is. If it's an index fund, they might let you borrow more than, say, like a random stock. But if you have $100,000 in, say, a said index fund that just mirrors the S&P 500 market, they might let you borrow 50 to 60% of it. 50 or 60% of the total assets that you have. So if you have $100,000, that would be 60 or 50,000. This is something the ultra wealthy have been doing for a while. Rather than liquidating their stocks in their company or anything like that, they just take certain loans as collateral. Since they have so much equity in their companies, they're able to get even lower interest rates than 2%. So just by doing that, they could basically not pay taxes and use that money for either investments, expenses, or whatever that they're using the money for. So this is something that people like Elon Musk or Jeff Bezos do. Instead of, say, liquidating their company, either Tesla or Amazon or anything like that, they just take loans against it, and maybe they're paying 0.5% or 1% on the entire loan. So some of you may wonder, how actually do you walk through and do something like that and get in the process of getting a loan against your stock market asset? So let's take a look at Fidelity. So let's navigate through Fidelity a little bit. So Fidelity is a pretty easy app to use. You could download it on your phone, or you could create a Fidelity account online. So there's different things you could get, from index funds to individual stocks, and it gives you a variety of different plans, from Roth accounts to traditional retirement accounts. So really a great app to use, and I recommend everyone have something, a brokerage app like Fidelity. And what we're going to be looking at today are margin loans. So if you wanted to take loans against your stock market assets, the thing is, you're going to need to have a certain amount of money in those stock market accounts before you can take loans. So let's take a look at exactly how much that is. So if you scroll down over here, as you can see, the margin interest rate, it says if you have 1 million, it's around like 4.25%, and sometimes it could be around 3%. So interest rates raise a little bit, so that might be the reason why some of these look a little higher than usual. And as you get lower, as you can see, the interest rate kind of gets higher. For 500,000, they charge you 4%, about 4.5%, and for 250,000, they charge you close to 7%. So it's really beneficial the more money that you have into accounts like these to take margin loans, because if you have a smaller balance, say you look all the way down up here, if you have, say, $24,900 about, they're going to charge you about 8.5%. So at that point, it doesn't even make sense to borrow against it, because that's basically all your gains. Likely, if you're investing in an index fund, it's not going to probably average much more than that 8.5%. So it's kind of risky to take a high loan like that. So really, this is beneficial as you grow your portfolio. Maybe it's something that you could use, but generally you don't want to use it if you have a smaller balance. This is something that you want to use as you accumulate a lot more money. And there's different places that you could invest your money. So it's all about finding preferable rates. Some companies might charge less than others. I'm just familiar with Fidelity, so I'm showing that with you right now. And as you can see, it says the interest rate is variable based. So that means it could change on a tiered schedule, which is determined by the size of the margin loan. So the more you invest, the lower your rate is going to be. And the good thing is there's no hidden fees when it comes to these things. You kind of know exactly what you're going to pay. There's no transaction fees when it comes to using an app like Fidelity. So that's the good thing about it. So pretty cool that you could take a loan against your stock market assets. It might not be applicable for everyone, but it's just a good thing to know. Later on, maybe if you grow a decent amount of money in your portfolio, you don't necessarily have to liquidate your assets. So I just thought it was interesting and a good thing to share. There is a particular risk in using a strategy like this, especially when you're leveraging the stock market. And the thing is, you might be in a position where you might have to liquidate your shares if you're over leveraged. What do I mean by that? So if you have $100,000 and the limit they allow you to take is 60%, and they don't let you go above that limit. They say 60% is the max they allow you to take out in terms of using that asset as collateral. If the stock market goes down, say to 50%, now that 60% pertains to that new value. So 60% of 50,000, that would now be 30,000 that you would have to have in terms of loans outstanding. So basically what they'll do is they'll liquidate the difference if you don't pay that loan back. So that's one thing you really want to be careful for, is if you're using a strategy like margin loans, you want to make sure that you're not over leveraging your account or anything like that. So maybe even using something like 10 to 20% might make more sense than using that entire 60%, because that's kind of risky whenever you take extremely high loans, especially on stock market assets that fluctuate a lot. And another thing you can do if you want to even limit your risk even more is you can invest in lower volatility things in the overall stock market. So maybe you could have some bonds in your portfolio that fluctuate significantly less than the stock market, or you could have some stock market assets that fluctuate less than the overall stock market. So you're less subject to market risk. So if the market crashes, you're not subject to having to pay that loan back right away. So that's some things you could keep in mind to kind of lower your risk when it comes to investing and taking out loans against your assets. And there's a lot of different types of bond ETFs that you can invest in, and you can kind of look to see which has lower expenses to them. So it's a really great way to control the volatility of your portfolio. So that might be something you want to think of, especially if you're using a strategy like taking loans against your assets. You might not want to use just stock market assets. So maybe even using bonds, you might not want to go over 10, 20% on the high side using a strategy like that. The thing is, there is risk involved. I'm just letting you know the risk involved. And if you want to completely eliminate risk and still be able to take loans against assets, there's some insurance plans that you could actually get a floor on the money that you put in, and you don't have to worry about losing money when the market crashes, but you could actually participate in the gains of the stock market, say up to 10%. It caps your gains, but it eliminates your losses. But the good thing about using a strategy like that is you could still borrow against an asset like that at a lower rate than what you're earning. So you could still make a spread, but it's a much safer way to make a spread on your money than being exposed to market risk. And the thing is, these are loans that you don't have to pay back. If you're interested in learning more about that strategy, I'll link a video to the end so you can watch a really detailed approach on how that exactly works. But as always, I post content every single week. So if you found some value in this video, go ahead, like, comment, subscribe. I post financial content and different types of financial concepts and financial plans. So if you're interested in that type of content, follow this channel, like, comment, subscribe, and I'll post another thing next week. Thank you.